Welcome back to RealCast, the weekly roundup of the real asset markets. My name's Richard Betts, and I'm joined by regular guests James Wallace, Dynes, and Nicol Dynes. Let's start with you, James. What have you been following?
Well, actually, the European investment volume by Savills came out recently during our break, and they show that the total volumes for H1 was just a whisker under 119 billion euros, which is actually only 1.3% below first half of 2019. And that's obviously thanks to the strong Q1 before the pandemic affected transaction volumes. In Q2, the volumes were 36.2 billion, which was the lowest quarterly volume for about 7 years and down almost 50% compared to the same period. But within those headline numbers masks some huge variation in the investment volume differences between countries. So it was actually Germany that was the standout, strongest performer, no surprise. Its year-on-year investment volume just for the market of Germany was actually 31% higher than the same 6-month period last year, which equates to 10 billion extra in transactions. And that was largely driven by Germany's multifamily sector. In fact, that they closed in H1 12.5 billion euros of transactions, which is almost 2/3 of Europe's entire 20-some billion in multifamily transactions. And so it shows you just how resilient that has been despite everything. And there's been some other standout kind of markets that actually outperformed, which is interesting, but they are the smaller markets, so it's easier for bigger swings in smaller markets. Luxembourg, a tiny property market, that market saw a massive spike of 173% in turnover volumes compared to H1 last year. Portugal was up 42%, and Czech Republic was also up double digits. At the other end, those markets that did quite badly included Ireland, Norway, and Italy, which were all between sort of 45% negative and 30% negative compared to the same period last year. There were some other thematic sector highlights. For example, in the logistics sector, there was a total of 13.3 billion across Europe in H1, and that compared to 14.5 billion in the same period last year. So it's a decline of about 8%. And actually, retail investment volume reached 18.3 billion. So that's actually up 1%. And the reason that might sound a bit counterintuitive, but the reason why European retail investment volumes has done so well is because there were actually, despite the doom and gloom at the high street level, quite a lot of transactional activity due to kind of food-anchored retailers that have performed quite well, and that's drawn quite a lot of attention of retail investors that have seen how resilient it is. And so there's been some sizable transactions around those kinds of assets. Finally, in offices, investment volumes reached just shy of 40 billion in the first half of the year, and it still remains the predominant asset class. Accounts for like 1/3 of all volumes, but that the weighting of offices is actually starting to come down, and I wonder whether that will sort of continue in the second half of the year too. It used to be 40% of the total volumes of European transactions, and it's now down to 1/3.
Yeah, it's interesting to see how some of these sectors are evolving. I was talking to Rick Graff at Pinnacle because he's joining us at RealX next week. And just interesting to see that multifamily really coming through now, perceived as a US sector, but now really coming through across Europe, I think. And James, in terms of the forecast, did you get any data coming through?
Yes, Savills actually did hint that they think that actually Q3 will be quite slow in terms of transaction volumes, and that's partly because site visits have been restricted, which is going to slow down due diligence. So we should expect muted volumes for Q3, and with a bit more of a bounce back in Q4. So they've given a range of expectations that European investment volume annual tally, the total, is between 220 and 260 billion euros, and that is anywhere between -29 and -16 compared to 2019.
Great. Nicol, what have you been following?
Well, Savills again brought out a really interesting report on logistics in Europe. And as everyone knows, the logistics sector has done well during the lockdown, and they add some figures to that. It sort of speeded up online retail sales by about a year, they say. And to just give an example, in the UK, it's gone up to 33%, which is quite the biggest percentage ever. And the six main EU economies, online sales were predicted to rise from 12% in 2019 to 16.2% this year. So that's the good news, and then figures on what we knew, but there's sort of a lot of question marks, a lot of uncertainty ahead because of consumer confidence being low, worsening economic situation in most European countries, as we expect, which will obviously not help sales in general. And also the WTO, the World Trade Organization, expects global trade to contract by anything between 13 and 31% this year. So logistics is doing well, but it's got a lot of challenges ahead. That's the bottom line.
Great. And Dan, what have you been seeing?
Well, over here in the UK on the news front, COVID continues to shake up the leisure and hospitality sector. And, sandwich chain Pret A Manger, last week they announced a major shift in their strategy in response to that, their recent struggles, mainly because, of course, they've suddenly lost its core clientele, largely commuters and office workers. The chief exec admitted that they've really been too reliant on London. And of course, we've seen them expanding across Europe as well. But the company's now going to shift its operations and strategy a bit more to focus on dinner deliveries and out-of-town shops. So they reported that sites in London had seen 60% lower sales, probably not unexpected compared to a year ago, but with even worse numbers in the City of London, which of course is, if anyone's been to walk around City of London recently, is pretty quiet. They also admitted they had to lay off nearly 3,000 staff, a third of its UK workforce, and close 28 London stores. But this refreshed strategy, it's going to, as part of that, they've actually even opened up a dark kitchen, which has been a very big topic at the Happetite or the MAPIC food discussions in the retail sector. Elsewhere, of course, many of us, we saw Hammerson fall out of the FTSE 250, and that was just days after the company had raised 800 million to sort of strengthen its finances. So Hammerson now sits in the FTSE small cap index. Hammerson's seen its shares fall by, nearly 70%, or just over 70% over the last 12 months, as it's been sort of battling the different headwinds. But at the same time, the company's still looking for successor to David Atkins. But, it seems like they're going to have to look outside the company for that role. And meanwhile, British Land, on the other hand, they were expected to fall out of the FTSE 100 and go into the FTSE 250, but after those results earlier this year, but they've just about sort of clung on to the 100. And then last up, Brunswick Real Estate. They've announced the launch of a third senior debt fund. They've already secured 1.2 billion euros for that, which is phenomenal in this market. The Stockholm-based asset managers, they've got backers including insurer Folksam Group. They've got Norway's largest life insurer, KLP, listed in that in backers. And that new fund's going to focus on lending to Swedish commercial property with clear sustainability goals. So that comes back to our ESG discussions before. And they're looking for those kind of investments with maturities over of up to 10 years. So like their previous funds, this Brunswick Real Estate Capital 3, as it's going to be called, is going to be unleveraged, and a formal first close is expected later this autumn. That fund's sort of double the size of the company's previous fund as well, and that marks a pretty major achievement for them. And of course, remember, they've also got a UK team too, led by Will Amies and David Turner.
Actually, I've been looking at the Bank of England's lending data among UK banks and building societies. They produce monthly data sets for the UK market, and this month, for the most recent month announced it for July, net property lending was down 1.8 billion compared to 64 million rise in the month of June. Now, you shouldn't look at too much from single months. I mean, it could just imply that there's been like a small number of large repayments in any one month. But more broadly, I think the sentiment within the lending market is kind of diverging between the way in which banks are thinking about the post-pandemic, or certainly the future, and how alternative lenders like Dan's story about Brunswick. I sense that like banks are starting to exercise greater caution, and at the same time, we've already talked about like we're expecting muted transactional activity to happen in Q3. So there's these two forces combined together of like the banks wanting to ease off, be more prudent, and there's also lower activity. So we're expecting lower new lending by the banks. That isn't to say that there aren't lending opportunities, because there's a huge amount of requirement for recapitalization of existing loans and new financing for opportunity purchases. But I think the expectation is it's going to come from more the alternative sector than the banking sector.
Thanks very much, James. Thank you, Dan. Thank you, Nicole. Thank you for joining us. And we'll be back again next week for our regular roundup of the key themes in real assets. Thank you.